If a stock has doubled or even tripled, you haven't missed it. So many times people think that because they've seen a stock go up significantly, the story's over, they should look elsewhere. And so many times that's just the first act to a very, very long play. Number one, we focused on what we thought we could predict, which is recurring revenue, predictable growth, cash flowing businesses, to the exclusion of everything else. Buffett talked about in an address he gave in, I think, the 1980s, looking for fanatics as his managers. So we look for fanatics and not mercenaries.
Excess Returns. I'm Matt Ziegler, Bogomil Baranowski, co-hosting with me today. Our guest, one of the rare active managers who's achieved sustained outperformance in an increasingly passive dominated market, ex-TCW star portfolio manager to now founder of Rainwater Equity. We'll talk investment discipline, quality as a strategy, adaptation to changing market dynamics, all sorts of good stuff. Joseph Shaposhnik, welcome to Excess Returns.
Thanks for having me. Great to see you.
This is going to be a ball. It's exciting to get you here. Now, Rainwater, you didn't want to go with sunny days? You didn't want to go with something more uplifting?
We have so many sunny days in Southern California, which we love, of course, but rainwater are the days that we enjoy the most because they come so rarely.
Okay, I'm going to take that because there's the Southern California overlay. Let's dive straight into the deep end here. TCW, New America Premier Equities. I mean, wild numbers. Really, really impressive. 16.7% annually versus the S&P's 13.1% over nearly a decade. Number one out of 343 peers. Looking back on that success, a couple of rainy days, what contributed to this?
I think it was a lot about unconventional wisdom and unconventional thinking with regard to what contributed to it. Number one, we focused on what we thought we could predict, which is recurring revenue, predictable growth, cash flowing businesses, and we to the exclusion of everything else. So what we found as portfolio managers and as an analyst is our portfolio managers wanted to have an opinion on all of the companies in their index, all of them. And what I found is you can't have an opinion on every company in the index. And where I saw them going wrong was having the view that they needed to have a bet on every idea in the 500 constituents that are in that index. I had a completely different view because I had spent time looking at businesses for a long period of time and looking at how they ran and how management acted and how difficult it was to operate these businesses. And I go back to this example of NVIDIA. In 2022, NVIDIA went down 50%. And that was just a couple years ago. NVIDIA went down 50%. And management sold $3 billion worth of stock in 2022 as the stock was going down. 1 year later, NVIDIA was up tenfold. And the management team, one of the smartest management teams in the world, left $30 billion of value on the table in a very short period of time. One other example, which I came across recently, we've owned Broadcom now for many, many years. And Hock Tan, I think, is one of the great CEOs of our time, one of the smartest CEOs of our time. And I went back to look at the IPO. And on the IPO, he sold approximately 150,000 shares at $1.50 a share. The stock is at $3.50 today, and that was 15 years ago. Even the best management teams have difficulty in predicting where their businesses are going to be. So for us, what we learned is we only want to be invested in recurring revenue, predictable growth businesses because we thought it gave us the best chance of evaluating where a business will be in a couple of years, betting with management teams that have an easier hand to play because they kind of know where revenue will be in a couple of years so they can match costs with revenues. They can also have more confidence in the capital allocation decisions that they're going to make or the investments they're going to make. So they have a chance of potentially outgrowing the market because they can make these intelligent investments that hopefully will drive growth over the next couple of years. So those were really important parts of I think, the drivers of our performance. I think also we were quick to eliminate losers. So if we thought we made a mistake, we weren't ashamed to make a change. I think also position sizing was a huge part of it as well. We had very large positions. At one point, we had a 20% position for a number of years in the portfolio, and other positions which were large as well. And so position sizing was very helpful because those positions started at 8% positions and then grew to 20-something% positions. But we were willing to let those businesses become a large part of the portfolio because the cash flows of the company followed the growth of the equity value. So we weren't allowing these businesses to become a lot more expensive, but we were allowing the cash flows to translate into higher equity values. And so for us, our review is free cash flow is what physically moves stock prices. So if we can find businesses that are continuously improving free cash flow on a regular basis, we're going to stick with those businesses. And lastly, and I'm sure we'll talk about this, we always tried to find management teams that we thought were the best and the smartest and the most appropriately incentivized among all of the opportunities that we could look at. We had a very narrow set of opportunities because we would only invest in predictable businesses that had recurring revenue associated with them. So within that set, we're trying to invest with the smartest teams we possibly could find, because we always felt as though businesses are run by people. They're not run by businesses. They're not run by products. You could have great products, but without great people, it doesn't work. So for us, we tried not to compromise on management quality, even if we thought we had a great business, or we thought we had great secular tailwinds, or we thought the business was attractively priced. We wouldn't compromise on ensuring that we had a great leader running those businesses.
You're touching on so many fascinating ideas, and we'll come back to them throughout this conversation, but I just want to point out one or two. One is the non-linear outcomes in investing that even the management cannot fully imagine and capture when a stock goes from 1 to 100. And Matt and I spoke with Chris Mayer a couple of times about those. And the other thing is, one of the limiting beliefs for investors maybe is the fact that the position, once it runs up, you have to trim it back to some target. People have 3%, 5%, whatever it is. But letting the winners run, what you talked about, that's a lot of money left on the table by a lot of people. We'll talk about it. But I want to ask you about Buffett. So Matt and I talked about Buffett here a couple of times. You follow Buffett, you're a fan, but you tell us that sometimes we take the wrong lessons from him. Can you talk about it, what we should learn from Buffett and maybe what we should not learn from Buffett?
Look, I think that for so many years, what people took from Buffett is buying inexpensive stocks and then selling them when they become more expensive or dearer. I think that was one of the key takeaways from what he had discussed for a long period of time and what people took away for a long period of time. Buy cheap and sell a little bit more expensive, and don't overemphasize business quality. Care about it, but don't overemphasize it. But when I look at Buffett and I look at the big winning investments that he's made, it has consistently been in the recurring revenue, high quality natured businesses. And where he's made mistakes, it has consistently been in the more cyclical, more difficult to predict ends of the spectrum. And when you look at what he paid for the Washington Post or Coca-Cola or Gillette, and even Apple, I think he paid a little bit more than the average market multiple at the time. He was willing to pay to get high quality. He was willing to pay to invest with Roberto Gozzietta, who was running Coca-Cola, or with the other great CEOs who were running these businesses. And those investments really worked out. I mean, if you go back and you look at the Cap Cities investment, he invested with one of the great capital allocators and operators of all time. And that was a huge, huge winner. If you look at what didn't work, most recently, I think about Precision Cast Parts. PCP was a business that was losing market share. It was a business that he thought he had gotten at an attractive price. It was a business that is highly cyclical. It had energy exposure, it had aero exposure, and it really hasn't worked out. So the lessons from Buffett are so many, but I think the key takeaways from Buffett is business quality is paramount, leadership is paramount, and predictability and recurring revenue really helps the investor stay with these businesses for long periods of time, which is one of the key factors that yields to high rates of compounding over long periods of time. But it also helps you invest in situations where the error rate or the complexity of managing the business for the management team is reduced, which allows for a better outcome for both the management team, the company, and the investor.
I'm not going to say he's the modern Warren Buffett, but he is kind of a Warren Buffett for another generation, and that's the great Bill Miller. And looking for growth, looking for it wherever you can find it in a growing sector, you look for certain tailwinds. I'm curious with you, Joseph, what about Bill and his investment style resonates with you? And then you got to tell the story about he backed a little venture of yours a little bit here. He threw some support behind you. Tell that story.
Yeah. Well, we're greatly honored that Bill Miller is the cornerstone investor for the firm that we recently launched, Rainwater Equity. He was our cornerstone investor, so we're just honored and pleased to have his support. I think it's very difficult to put Bill Miller in a box. He's one of the largest shareholders of Amazon and has held Amazon since the IPO. One of the largest, or I don't know if he's one of the largest shareholders, but he's one of the early shareholders or owners of Bitcoin for such a long period of time. But Bill Miller is one of the value investing legends of the last 25 years. He's somebody who could, I think, operate several strategies within his fund, both the deep value approach that I think he did really, really well, and he could rotate from one sector to another where he saw value move to. So I think that helped him a lot and helped him generate that unbelievable record against the S&P. I think beating the S&P 13 years in a row or something along those lines. But he could also not just identify what was cheap and going to get better, but he could also stick with the great winners. So he held Amazon for such a long period of time. He held these other businesses for such a long period of time. And he was able to do that in a dynamic portfolio where he was entering and exiting based on value and the outlook, and also hold on to those winners for long periods of time. So I think that when I think about him, I think about somebody who was very, very dynamic and could find value in many different markets and in many different places.
You bring up quality, and we talk about great businesses, and it means different things to different people. Can you talk about your perspective? What are the specific traits that you look for before a company earns a spot in your portfolio?
Yeah, we look for three elements. Number one, we'll only invest in recurring revenue businesses. Number two, we only want to invest with great leaders or strong leaders. And number three, we'd like to hold these businesses for long periods of time. And so if we were to peel back the onion on each one of those, on the only invest in recurring revenue businesses, we're looking for a business that has a very, very strong market position. So monopoly, oligopoly, a couple of competitor market. We're not really looking for that early stage company with a lot of competitors that has the best product and then now needs to beat all of the competitors out. That's not really our game. We want to invest with a dominant position in an industry or product that is not discretionary. So you won't see us invest in discretionary products like restaurants or clothing or fashion or those types of end markets. You'll see us invest in stock exchanges, software companies, aftermarket aerospace parts where they have monopoly positions, service businesses where they have a monopoly on the service itself. We have to be in a business that has that dominant position that's going to be difficult to displace. And there has to be an element of growth and free cash flow associated with it. So there are a lot of businesses that fit those parameters that don't grow. Mm-hmm. And that is not going to drive equity value. A great position without a growing opportunity is just a great position and consistent free cash flow. And then you hope a kind of an equity value that doesn't go down, but it certainly probably will not go up. So there has to be an element of growth associated with it that will both drive the business and the top line, and most importantly, drive free cash flow per share, which is what we're looking for. So when we think about the business aspect, those are the elements that we're looking for. When we talk about great management, we're looking for some elements that are a little bit unusual. Number one, Buffett talked about in an address he gave in, I think, the 1980s, looking for fanatics as his managers. So we look for fanatics and not mercenaries. Mm-hmm. And so I think we'll talk about some investors that are fanatics, but when I think about the winning businesses, they are run by people that are passionate and have a mission. Mm-hmm. They're on a mission to build this business. They didn't just go from one job to the next. They started this company. They took a company out of private equity the way Hock Tan did with what was called a Vago. It's this little teeny weeny semiconductor company that was kind of an afterthought, passed around by private equity, but he got it, and they had these nice positions, and he spent the next 20 years building it. That's our kind of leader. Or Mark Leonard, who saw this opportunity in boring and unloved software businesses, and then spent his life building it. Those are our fanatical leaders. And of course, we're looking for leaders that have a track record of outperforming their competition. But they are fanatics. They're dedicated to this business. And why should you expect great performance from CEOs that are not fanatics or dedicated to their companies? You probably shouldn't. When we see changes in CEOs and we think that this person is probably not a fanatic, that'll really cause us to think differently about the business. And then we're looking for management that is incentivized to do the things that we think will grow equity value. Naturally, if we think that free cash flow is what physically moves stock prices, we want to be aligned with a team that is at least to some extent compensated in a way that's going to cause them to think about growing free cash flow per share. So the incentives have to be set correctly as well. And lastly, because these recurring revenue businesses generate a lot of excess free cash flow, we're looking for management teams that have the ability to be great investors with that free cash flow. And so we're focused on compounding free cash flow per share at a high rate for a long period of time. And so we prefer to have that free cash flow in the hands of a great CEO investor who can reinvest and generate more and more free cash flow. If the business isn't in a position to reinvest all of its free cash flow, we then would prefer to see opportunistic share repurchases, and we don't prefer to see dividend distributions. That's not what we're investing for. So those are kind of the broad elements of what we're looking for in terms of the business, the management team, and of course, we want to hold these businesses for a long period of time. And I think you guys have done a great job of describing why that's important. But I think maybe what is underappreciated is if you have these other elements in place, you want to give the management team the time to execute the strategy and to go through the inevitable bumps in the road that are going to happen. And if we're too quick to change our minds on positions, we never give these great leaders the opportunity to play the hand out. So I think those are kind of the key tenets of what we think about.
At the risk of getting too nerdy, and first off, let me just say, Fanatics versus mercenaries, I'm going to broaden that definition out to say the Phillies postseason is looking really good for me right now because we have a fanatic, and I will extrapolate to that point. But literally, maybe a little too nerdy, but I want to go there. Free cash flow compounds, drives equity prices higher over time. Not tomorrow, over time. Can you give me, doesn't have to be a company, a counterexample? Like without free cash flow, why does that not compound? Why does that push the stock price down? And then turn that around and tell me why it's so important. What's the accounting that's going on here? What are you actually studying? What do you actually care about with those numbers?
Well, look, there are rules and there are sometimes non-rules. Because if you go back and you look at the Amazon story, there was not a lot of free cash flow and there was a lot of equity value compounding. Those are the exceptions. And if you peel back what Jeff Bezos was doing, you could find a lot of free cash flow. He was just reinvesting it kind of above the line. He wasn't showing it below the line. So sometimes you have to tease that out, but we like more simple and straightforward situations. And what we're looking for is, if we can find it, and Buffett has described this many times, the ideal business is one that grows its top line and grows its free cash flow without requiring a lot of reinvestment. So the ideal situation, if we're going to get nerdy, is the royalty business, the franchise business, or the business that has pricing power on the existing product and the product doesn't require a lot of reinvention for you to continue to grow it. So if you look at software businesses, particularly those where the product has staying power, that's an ideal free cash flow compounding business because it's not capital intensive. It's written once and hopefully with AI less expensively than before, and can be monetized across a large number of customers for a long and recurring period of time. And if you're fortunate to have a strong enough position, you can tie the pricing of the product to either add-ons or inflation escalators that grow consistently over time. And if you can manage your costs better, you can then see growing free cash flow without a whole lot of change to your business. Now, the best businesses are always improving their product, improving their positions. But when you start with a strong position and you can expand that position, that makes your life as the manager and your life as the investor so much easier because it takes less figuring out to determine whether the company is expanding their moat, holding their moat, or experiencing a deterioration in their moat. And as investors, we're always measuring that and trying to enter situations where the moat is expanding and growing over time.
You know, speaking of moats, I had this image of a toll bridge. A lot of investment books talk about it. Apparently, Buffett had an opportunity to buy a toll bridge at some point. Brett Gardner told me that. I'm yet to confirm the story. I don't know if you know more. But anyways, I see from what I'm hearing from you, a toll bridge that everybody has to go through with growing traffic. I want to go back to the management because I feel like it's a fascinating topic. You talked about what you're looking for. I'm curious about some red flags. You know, you find a business that looks really good on paper. I've been in meetings with companies where everything looked just so good. And I would walk away from the meeting, and for lack of a better way to describe it, I wouldn't leave my wallet with the folks I just met. That was my red flag, doing this for 20 years professionally. What are your red flags? You walk out from the meeting or you get to know the management and you're thinking, no.
Well, you know, it's like you, I've probably done thousands of management meetings, and you've seen so many different situations throughout those meetings. And, you know, so many things kind of catch your eye. I think about going back to the numbers, and what resonates with me very often, and hopefully this answers the question, but I think it'll get back to the question, is I'm always interested in looking at what are the numbers that the management team is presenting us. Of course, they have to present all of the regulatorily required numbers in the Ks and the Qs. But when I see what they present us in a press release, or even more telling, a management presentation, or in an analyst meeting where it's a 150 slide presentation, that immediately tells me what is important to them. Because what they have to report to the SEC is required. They have no discretion over that. But what they put into their presentations invariably is what's important to them, and then is what is presented to their employees, which is what now becomes important to their employees. Mm-hmm. And so the first question is, do these numbers connect with what's going to be important to improving the position of the company itself and growing the company, growing the moat, and of course, what does that mean for shareholders? Or do these priorities translate to what's going to matter for us as shareholders? So many times, so often, you get a 25-page presentation when you enter the room with the company. You look through it. Sometimes you can't find numbers. That's not good. Sometimes you open the presentation and the numbers are exactly what you want to measure. You see the segment reporting, you see translation of free cash flow, you see the organic growth measured, you see the things that will translate into what will matter for investors and the key metrics that management should be monitoring on a daily basis. That's the kind of the ideal situation. And what you hope is that you can draw a line from those numbers, and oftentimes you can, to what's in the proxy with regard to what they're getting paid to do. And when you see that, you can kind of sit back and you feel more comfortable that they're thinking along the same lines that you are. I'll give you the flip side to that. The flip side is when you've got a management team that is making decisions that they can pro forma out of their compensation measurements. In other words, they're taking on a capital project. Let's say it's a technology transformation, and they need to lay out a couple $100 million over the next couple of years to bring their tech stack to wherever they need it to get to. But they were getting paid on EBITDA or operating income. And they decide that while a lot of this is going to hit operating income and EBITDA, you look at the proxy, they're able to exclude it. That's a terrible sign. If the management team is going to make an investment, they should have to live with that investment just like all of us do. And so we want to make sure that we're treated the same way that the management team is being treated, and they're thinking of us as partners. So that is definitely something that we pay attention to. If we see them performing out investments that they're making, that's a terrible sign. I think another element associated with this is acquisitions. And the ideal company holds the management team responsible for the acquisition in some way through the metrics that they measure when they compensate teams. The ideal situation is you have an element of return on invested capital as an element associated with management compensation, and you don't pro forma the deals out from that calculation. That's ideal. It rarely happens. But some responsibility for the improvement of or generating returns from the acquisitions is really important. Now, you can offset that by having a management team that has a track record that is stellar on acquisition. You can offset that by investing with teams that are invested in the equity value of the business itself. That can help as well. But you want some linkage between the two elements, and then you get into meetings with management and you want to talk to them about the numbers, and if they're resistant or unwilling to discuss certain figures or situations, that of course that can be frustrating. But over time you kind of select the management teams that you want to spend time with, because an hour-long meeting can be a long time if you're not happy with the way things are going. So those are kind of some of the elements that at least we think about as we've assessed management over so many years.
Well, you're half an hour into this hour-long meeting. I hope it's going better than one of those. All right, you can get all this right on the selection side of securities, but you've also talked about, especially in standing up the new shop, the great transgressions. Because even to get the companies right, you could screw up a lot of stuff still. It's not that easy. What are some of those great transgressions? Why is your new structure different?
Well, I think you're referencing my view as to why the mutual fund / active equity management industry is broken and struggling. And the number one reason is this obsession with managing to the benchmark. And when you manage to the benchmark, you have to have an opinion on everything in the benchmark. Mm-hmm. And what we've found from studying the performance of managers over the years, and I've worked at some great firms and had the opportunity to have a front row seat of things that have been fantastic and things that haven't worked very well, is there's that overconfidence. And that overconfidence, no matter the number of MBAs you put to the problem, you can't predict every single business. And when you feel like you can, you get into situations that hurt the performance of your fund. The challenge is when you have an investment thesis for a business that has cash flow going like this and wiggling all around, and the investment thesis isn't going your way, you're put to these very difficult decisions. What do? Do you average down and add to the position as the quote unquote macro is going against you, or the management team is making decisions which are running contrary to maybe the short-term desires of investors, but maybe positive on the long run? You're put to these very, very difficult decisions. And I think decisions that most investors, like most management teams, don't get right very often. I mean, we've looked at these examples that we talked about a couple of minutes ago. And so that hurts the performance of a portfolio more than most people think. Oftentimes, investors get the big weightings correct, but then all of these low conviction bets that populate these large number portfolios, the low conviction bets, they add up, and then they hurt the performance of the portfolio. So for us, we're keeping the portfolio concentrated, not too concentrated, between 20 and 30. I ran the old portfolio at below 20. So we're between 20 and 30. We've kept ourselves under certain concentration limits because we want investors to feel really comfortable as they invest with us. But I think the first thing is not to be overconfident and to feel like you can have an opinion on all of these individual businesses. That for us is the big transgression. Having the view that you think you can predict all of these businesses when you really can't, because even the greatest management teams can't figure it out.
You're touching on so many fascinating ideas. We had Robert Hagstrom on this show, and I got to listen to him speak in Omaha at Guy Spears Value X, and he was making a point, read those studies about people that outperformed the market in the past. But what we forget to say is that these were concentrated portfolios. And when we say concentrated, a lot less than 20, which I feel like it's 20, 30. It's a good place to be, just me personally. We can talk more about it. He also added there was usually a huge tracking error compared to the benchmark for those portfolios. And the part we don't like, there were big drawdowns in those portfolios. We don't talk about it, but if you want to really outperform, you have to swing and you have to take risks and you have to be ready for a journey. I write about it. Clients that I work with, families with multi-generational wealth, they're not willing to have 5 stocks and go for a ride like this. But if you really, really want to outperform, you have to take those bets. Can you go a little bit deeper? 20, 30 stocks. Can you talk about concentration, position sizing? How do you balance conviction and risk management? I think that we all are just wrong sometimes. And I personally want to be the least wrong. And if I am wrong, I don't want to pay too much for it. So I'm curious how you think about it.
I think that's the reason recurring revenue businesses are so ideal. Because when you have a recurring revenue business, you are put into less situations where you have massive drawdowns. If you invest in a business that has 75% recurring revenue, no meaningful amounts of net debt associated with it, abundant free cash flow generation, and a very strong position, you're not put into the same bucket as the managers that Hagstrom just described. He's describing managers that are taking large bets in situations they think will have asymmetric payoffs associated with them. And those asymmetric payoffs, if they don't work, could be in cyclicals, could be in businesses with a lot of leverage on them, could be in businesses that are in very competitive markets and competitive situations. And any combination of those will kill you. Any one of them will hurt you and create the drawdown, but put together 2 or 3 and they will destroy the equity value. When they pay off, they work great. When they don't, they create that massive drawdown that your investors and my investors won't tolerate. Mm-hmm. If you're in recurring revenue businesses, when you make a mistake, and this is what we learned over the course of managing the old fund for 10 years, when you make a mistake in the recurring businesses, I think that the magnitude of the tracking error that's created, or the negative tracking error that's created, nobody cares about positive tracking error. They just don't want the negative tracking error. We all want the positive tracking error. But the negative tracking error that's created is mitigated by the strength of the business itself and hopefully the appropriate capital structure, the free cash flow itself, and your confidence in the management team. They also, in my experience, they give you time, because they're such durable assets, they give you time to change your mind. Mm-hmm. In situations where you're leveraged, you're cyclical, you're in a competitive business, the impact's like that. Mm-hmm. You don't have a lot of time to evaluate the situation, evaluate new facts, and change your mind. The recurring businesses both are more durable and have less downside risk in our experience, generate less beta in our experience. So if you look at the old fund's beta, despite the tracking error, despite the large position sizing, I think it was 0.95. And so with this type of approach, you can generate, we believe, better returns as we did before, with lower volatility and lower downside risk, particularly when the macro goes against the world. These businesses should hold up better. Now, from a portfolio construction perspective, our view is we shouldn't have to have any position started at above a 10% weight. And so we're starting positions below a 10% weight. We're going to be willing to allow the winners to win and to run. And we're obviously cognizant of sector exposures, not obsessed with them, not overly obsessed with their sector exposures relative to that of the benchmark. But it's a diversified portfolio. As you said, 20 to 30 stocks is quite a good number of stocks and presents quite a bit of diversification. I still think it gives you the opportunity to generate outsized performance as we did with the old portfolio. When I started the portfolio, the fund last time at TCW, I think we started with 35 stocks. And so we came down from 35 down to 30, down to 25. And so the average of the average number of stocks that we held was probably around 20 to 30 over the course of the life of the 9.5 years. And I think that is enough. That presents enough concentration to generate whatever we generate, 350 basis points of alpha after fees. It gives you enough opportunity to do that. So I feel very comfortable with that. And I feel like investors can get comfortable with that 20 to 30 range as opposed to going lower, which is 1 to 10, up, 10 or into the mid-teens. You get more concentrated there.
Do you care about sectors? Do sectors matter at all? Is it just the individual companies and how they stack up and you don't care where they come from? What's your take?
I'm less concerned about sector exposure, but I do like diversification of the revenue and free cash flow streams of the businesses. So we have some sector exposures because we just naturally like certain sectors. They have these recurring revenue monopoly-like positions that we gravitate to. So we're cognizant of the sector exposures. We want to generate a smoother ride with our portfolio if we can, while still delivering good performance. And so we're cognizant of it, but we're not obsessed with the differential between how much we have in technology relative to that of the S&P 500, how much we have in consumer durables relative to that. We're not obsessed with that. We've got such a stringent set of criteria to get to where we want to go that we can't now add a lot of other artificial constraints on what we're doing.
I imagine there are sectors you would never invest in.
Are there sectors that we would never invest in? Yeah. There are. We don't really want to be in a business that can't control its own destiny. Mm-hmm. And so if the business is a price taker, energy, financials in a lot of ways, we're utilities in a lot of ways, we will shy away from businesses that can't control their own destiny and are tied to a macro end market or tied to an underlying commodity price that is difficult to predict. And so we'll naturally shy away from those businesses and we'll stick with those businesses where they're really in control of their own destiny.
I do want to ask you about your self-discipline, but before that, I want to sneak something in. What stands out to me is how comfortable you are with ignoring a big part of the universe. And I want to bring it up because I remember vividly a year or two before the financial crisis, I got to meet Jean-Marie Eveillard, that I met many times since, a legend in value investing world. So many people in the audience might know who he was. But at that lunch, very small lunch, he told us, I don't understand banks and I don't own them. And I thought somebody that has studied every business out there that you can think of was so confident and comfortable sharing with us, I just don't get the whole industry. I mean, he gets it well enough not to participate. And I just remember this remark because we all know what happened a year or two later. But I thought, we go into investing thinking, and you brought it up many times, and I think it's really powerful that we have to have an opinion about every single thing. We don't. I think it's really important to know that. That's what I wanted to sneak in.
I couldn't agree with you more. And I'm always reminded of that when I see management not know. Even the management team doesn't always know. How can we, as students of their industry, students of their company, outperform what they know? And so it's a very humbling profession. And as you so smartly pointed out, we don't have to have an opinion on every sector. Mm-hmm. From my perspective, all we're trying to do is get in the way of a large and long wave of free cash flow growth. Mm-hmm. It could come from the technology industry. It could come from consumer staples. It could come from a services company. At the end of the day, we just want to get in the way of a lot of free cash flow growth and hold on with a great management team. It's not more complicated than that. If you're able to do that and own a collection of businesses that can compound free cash flow at higher than that of the market, you're going to do well over a long period of time. And I think over a reasonably medium period of time as well, which, we would like to perform well over both types of time frames. We're committed to the long run, but we think that over both time frames, that strategy will generally work for us. And so we don't, as you said so smartly, we don't get kind of caught into the thinking of we have to have exposure to each one of these sectors. And I think it's such a destructive mentality, because what I've had happen and experienced is my high conviction investments that are working can be offset by these low conviction sector exposures that you're trying to, just go along with the way everybody else is thinking. And then you end up with a portfolio that didn't generate any performance, because you try to conform to what everybody told you needed to do. And in the positions where you had high conviction, they were diluted by these positions where you had low conviction. And then you end up with, a puddle of mush. And who wants that? You're almost better off sitting in cash. At least for that period of time, it's not destructive. And as you've seen, and I'm sure you've experienced, stock prices can go down very quickly and stay down for a long period of time. It's better off not to have the exposure than to have bad exposure. I call it like loose beta exposure. You shouldn't want to have loose beta exposure. It can be very destructive very quickly, in my experience.
When I see somebody's portfolio, I feel like it tells less than half of the story. So a position that is 1% could take up 50% of your attention. And after a quick conversation, you can figure out where somebody's attention is in that portfolio. And I learned the hard way, and hopefully people listening to this can take this lesson for free here. If you have a position that takes up 1% of your portfolio but half of your attention, sell it. And speaking of selling, tell me about your selling discipline.
Well, look, the selling discipline, the first thing that we're looking for is, are we wrong?
Yeah.
We're often wrong. That's part of this business. And the key, I think, to working with being wrong is try to identify that you're wrong more quickly and be more decisive with it. So the first element of the strategy of the sell discipline is we're constantly evaluating these businesses to ensure that the three key tenets of the investment philosophy are being upheld. And if they are, we're happy to stick with the business. But if we're seeing something that is deviating from that, and I'll give you a perfect example of this, which is, I think, unconventional. We were invested. I'm going to leave the company anonymous. I don't want them to be mad at me. But we were invested in a great company, and this is several years ago. And the CEO, everything fit. The CEO was great. He took them from being an underperformer as a private company, took them public with the help of private equity, did an unbelievable job. And we had studied the team. The position was great. And one of the things that's important to us is to know the next layer of management. One, we want to judge how skilled they are at what they do. And two, in the event that one of them is promoted to CEO, we'd like to have an early read on whether they're good or they're not. And so we're invested in this company. It's going great. We've doubled our money. We think it's going to continue to work. And then one day we wake up and they announce that this 50-year-old CEO is going to retire. And they're going to promote the head of the US business. And that, for us, we knew who the head of the US business was. Mm-hmm. That, for us, was a huge red flag. We sold the stock that day. We don't normally change our minds and sell that quickly, but we felt so strongly that it didn't make sense that CEO was going to retire at such a young age. And we felt so uncomfortable with the promotion of the individual who was promoted into that seat that we felt we had to exit, and then we had plenty of time to reevaluate. There was no rush to continue to own it. We could evaluate it as the data and the information on and the work that we could do to assess the new CEO kind of came to us. And we're not always right. And in that situation, we were very right. CEO took over, has not done a good job for that company, and the stock has underperformed significantly. So sometimes the investment thesis changes and you have to act, but sometimes the management team changes and it just doesn't make sense. The gentleman is 50 years old. The business is on a great path. He's done a great job. And now he's retiring, and now he's handing it off to somebody who hasn't been CEO before, we judge to be not that great of a manager. That's not a good situation. It shows a lot about how the board is thinking about holding management accountable. And it was breadcrumbs to how the board would react to acquisitions, which didn't make sense. And it doesn't bode well. So that's those are some of the things we look for. And of course, if we have a better idea, we'll consider making the change. And one of the things that I always think about in investing is what you own, really well. So the bar for bringing something new to the portfolio needs to be really high. What you have high conviction in, and you've diligenced a great deal. And I was always curious, and I always thought it was curious where you could bring an idea to a portfolio manager and they would buy it on the spot. Well, what do you think of the rest of your portfolio? It's that low. Your conviction is that low that you're willing to bring something in that quickly. I always thought the bar should be very, very high. And so if we find an idea that we think is more compelling than what we own, we will sell one of those businesses to replace it. We don't particularly like running a portfolio with more businesses in it than what we would like. So we stay very disciplined in that zone of 20 to 30 businesses and not allow kind of the addition of another business to dilute the rest of the portfolio. We want to take out the worst idea that we have and replace it with this new idea. So hopefully that gives you a sense on sell discipline, the way we think about it.
One thing I love in breaking down all those factors, all those details, portfolio composition is, I don't even know if you've mentioned valuation yet in this conversation.
This is my picture of the two giants here, Mark Leonard and the CEO of TransDigm, Nick Howley, at a dinner. The significance of the picture is probably not valuation related, but it's two giants in their industry intensely discussing something at an awards dinner. Two people that don't really do a lot of interviews. Two people that know each other really well. To me, it's a reminder of the importance of investing with these legends. And that these two people they're exceptions. They're not regular people. If you look at where they came from, their life story, Nick Howley, I think he worked in his family's machine shop as a kid, played football, was an engineer, and then just started working in a factory. And he saw the opportunity to acquire an aerospace aftermarket parts business, I think from the company that he had worked for with a partner of his. And they just grinded it out. They bootstrapped it, and then it was one deal after another. And then it was, and Mark Leonard and Nick Howley, they know each other, and you can kind of see it from the way they talk and they look at each other here. And Mark Leonard with his own story, which is as unique as Nick Howley's. And, it's just I keep this on my desk. It's a reminder of the kinds of people that generate huge returns. It's not average people who are doing this. It's really exceptional. It takes exceptional people to generate exceptional outcomes. I've never come across a CEO who generated an exceptional outcome who didn't have some kind of an exceptional background, life story, or motivation. And, I think it's because it's really, really hard. And if you're totally rational, maybe you won't go through the pain of these really, really hard businesses. And it's just a reminder that, it's like with Will Danoff, and I think when I think of him, somebody I worked for a number of years at Fidelity, he's like these guys. It's a mission. It's not a job. It's not something he is there just to do. It's a mission. These people are on a mission. For him, it's to deliver great performance for his investors. For Nick Howley and Mark Leonard, they're on a mission. And so you could call them fanatics. You can call them people that are on a mission to deliver success to employees, to customers, to shareholders, to themselves. But these are the types of people that we only want to look for, because we haven't found that ordinary people can generate extraordinary performance by being ordinary. They have to do something unusual.
What I'm hearing and what I've heard in so many conversations on my podcast is that we're trying to find something that's not for sale, something that no money can buy. And I think we get incentives so wrong so many times. They're the basic incentives that convince a guy to show up at 4 a.m. and open his bakery. And we're trying to apply that incentive to somebody that's on a mission, running a big business. These folks that you described and many more that come to mind show up every day and do their best, no longer for a paycheck. They probably have never done a single thing really, really for a paycheck, unless they had to pay rent as a student. But since then, they're on a mission doing things. And no matter what incentive system you set up, as long as it's not insulting to them, I think that's the key. As long as it's not insulting to them, they will show up and do their best. And they will do things that nobody can really, judge yet, evaluate yet, that will have benefit in the next decade. And they go beyond the quarterly earnings reports. They go beyond anything, any investor conference. They're building something. And to find folks like that, and there are not too many, and latching onto them as a public shareholder, minority shareholder, you're going to win. And the valuation, I think it matters how much you pay. I'm curious how you think about it real quick. But I want to ask a big overarching question. I'm going to lump a few in one. There's a change happening, how we think about value investing, and things that you brought up, intangible economy, capital-light businesses, intellectual property, software, things are changing on one hand. On the other hand, I think we can't deny that AI is changing things as well. I'm curious how you see the future. Mention briefly how you think about valuation, or as much as you want, and then how do you see this whole idea of finding businesses in this ever-changing world changing?
Well, it's about what you can do with the asset.
Yeah.
I feel like value investing, where it went wrong, was an overemphasis on current value and an underemphasis on future value. And I feel like the pendulum has now swung to, let's focus on future value, maybe to the detriment of investors, because valuation is about, I think, mostly future value, but also to some extent current value as well. Mm-hmm. For us, the way we think about it is we're trying to gain as much free cash flow compounding for every multiple of free cash flow that we're paying for. And so we try to optimize what are we paying for and what are we getting, because we're willing to pay more for an asset that's going to generate 2 or 3 times the average rate of free cash flow compounding that we might expect from that of the typical S&P company. And oh, by the way, will probably be more durable than that of the average S&P 500 company. So ideally, we will pay no more than the market multiple for our business when we enter, and we hope to get multiples of the rate of the S&P's underlying free cash flow compounding. We target a mid-teens rate of free cash flow compounding for the individual businesses in the portfolio, because our goal is over the long run to deliver a mid-teens rate of equity value compounding for the fund that we manage. So that's the way we think about it. We're trying to be very sensitive to the starting multiple, but we're trying to be as sensitive to what are we getting? When will this starting multiple be cut in half? How long will it take for free cash flow to compound at such a rate to where the starting multiple now looks like it's inconsequential? That's as important as anything in our minds. And how much risk are we taking to do that? So when we think about portfolio construction, we don't have our highest projected return business as our largest position. We have what we think are our most durable assets that meet the criteria that we've outlined to our investors, but we want to have our most durable assets with the highest weighting in the portfolio. And perhaps the businesses that we think have the most upside, they may not be in the top 3 or top 4 positions in the portfolio. They may be 5, 6, 7, 8, or 9, because we want the most durable outcome. We're not seeking the absolute best outcome we could possibly achieve. You brought up the way the economy is changing and how that impacts valuation and the way to think about businesses. It's interesting because today margins on the S&P 500 are the highest they have ever been. Mm-hmm. Returns are at rates that they as high as they have ever been. There are folks that are in the camp of mean reversion, and they've been talking about mean reversion for the last 15 years. And if we had listened to the mean reversion crowd on the index and on gross margins, returns, earnings growth, we would not have performed very well over the last 15 years. But I do think that the economy is changing. That may justify a higher average multiple on the S&P 500 because returns for S&P businesses are higher than they have been, and margins are meaningfully higher in the United States relative to outside the United States. Now the spread between the multiple in the United States and the spread of the multiple outside the United States is as wide as it's ever been. The U.S. market is more expensive than it has been for most periods of its history. So it pays to be very cautious and to select very carefully. The market is more concentrated than it has ever been. That could be cause for great concern. Mm-hmm. It also could be cause for recognizing that there are a lot of businesses that are really exceptional, that are run by really exceptional people that we have not seen in a long period of time, that are gathering more of the cash flow, more of the gross margin dollars, and more sales than has historically been the case. Does that mean revert? It's uncertain. We'll find out. But it is difficult to argue that these businesses are not performing exceptionally well. They are performing exceptionally well. They are generating a lot of cash flow. They are generating a lot of economic value. Now, does that justify their current multiples? In some cases, I would argue yes, and in some cases, I would argue probably not.
I'm going to get you to closing questions in just a second. I've got one more because it's come up so many times, and especially after that answer, I'm really curious about this. Mike Green, Passive Investing, Distorting the Markets. Whether or not you're familiar with Mike's work, Is passive distorting things? Does passive matter to you? Is it part of the equation at all? Or is it just a headline in the ether to you?
I think it's a reality. I think that I try to never fall into the camp of there is nothing I can do. The quants and the passives are beating me, and that's just the way it is. I feel like there are a lot of folks that say, "Oh, geez, this is too hard. It's harder than it's ever been. Look at passive. Look at the computers. Look at AI. This is the game that we can't win." I really reject that. I don't think that it has put active managers in a place where they can't outperform. I think that it has become harder to outperform. I think that the reason it has become harder to outperform, and I know this is a controversial view, I think it's become harder to outperform because I think more information is being reflected more quickly in asset prices in real time than has ever been the case. So that means that the pricing of businesses, whether accurate in that moment in time, may not be the case, but the information is being reflected in real time, which is changing the way information flows into prices, which I think has forced us to be even more long-term with our orientation and our thinking, because any short-term advantages, I think, are being rapidly competed away because information is so readily available and being so rapidly reflected in the share prices of businesses. I think that there are a lot of people who say passive is making active easier to perform because there is less active competition. Every day, more active managers leave the market, and more of this is being competed away by passive. That, in theory, sounds good, but in practice, that is not what I see. I see security prices rapidly reflecting information more rapidly than when I entered the business a long time ago, which just means that you have to become more long-term and have, I think, a greater conviction in the people and in the business that you're investing in.
I would add to it, I've been investing professionally for 20 years and a lot has changed. And maybe the most has changed in the last few years. But I see the market reflecting information that I don't even pay attention to. I see the stocks dropping 10, 20% because the guidance was lowered a little bit. And if you actually look through the numbers, the business is still doing fine, not growing as much as people thought, but still healthy, lots of recurring cash flows. And I see those moments that because of the combination of things that you mentioned, how quickly, not even us, but machines process information, respond to those announcements, how much of the participation is passive, how few people are actually looking at things and thinking about things and having an opinion about things and acting on it. I think it creates an opportunity for folks like us that actually look at stuff and make up our mind. I do want to sneak in a question about somebody that had a huge influence on me that you met in person. Years ago, I was a student in Brussels. I picked up a book, One Up on Wall Street, in a small bookstore. And I wouldn't be a part of this conversation if not for Peter Lynch and his book. But for a long time, I thought he was dead. The same way Buffett thought that Graham was dead because there wasn't much more about him. He decided to retire. Incredible record. A lot of people know about him. A lot of people chose the profession we're in because of Peter Lynch. You met him. What's he like?
He's very curious and very passionate about stock picking, even in his older years these days. As you mentioned, I met him many years ago when I was at Fidelity, and I met him in the most special of days at an investor conference out here in Los Angeles, where I'm from, and had the opportunity to spend half a day with him, sharing meetings, talking about investing, talking about ideas. A lot of fire. Reminds me of the great Will Danoff, the great managers that we try to invest with. A lot of fire for investing. He has a team of analysts that work with him. He's very involved in investing. And, there are some learnings from those conversations that I had with him. And like you, I read some of his books growing up as well and was inspired by him, and still use some of those same principles today. But, what I recall from my recent conversations with him, is a couplefold. One is he sees the opportunity in focusing on small caps. So he spent a lot of his time on small cap businesses. He likes some of the same themes that he liked when he wrote the book One Up on Wall Street and some of the other books that he wrote, insofar as he likes those build once and then replicate across the country physical business models like restaurants and retail stores. Still interested in those types of businesses. He certainly likes restaurants. And so we talked about that. It's kind of a reminder of this is pattern recognition for what can work. What worked in one city and then was tested in another city, was tested in the third city, that really can go across the country. And so that's something that I remembered. I remember he talked about La Quinta hotels in the book many years ago. Mm-hmm. Same example. Dunkin' Donuts, same example. He was talking about the same types of businesses that are recently IPO'd today, same business models focused on kind of following that process and not reinventing the wheel. Wasn't reinventing the wheel very much. And, if it works, why change? What also surprised me, and maybe I shouldn't have been surprised, is he was so prepared for our meetings with management. He knew exactly the swing factors in those stories, and he went right to those points in the discussions with management. He ran a management meeting. As we grew up at Fidelity, we saw great management meetings run by great analysts and great portfolio managers. And he had such an influence on everybody at Fidelity, even today. His influence is still there. But his ability to get to the point with management, to come in very prepared to the meeting, and to get what he needed to get out of that meeting, was as good as I'd ever seen. He was that good, even at his age. Preparation was incredible. We talked about the macro, and he's very consistent on the macro. He's focused on finding great businesses, and not particularly focused on the macro. He's macro aware, but he's not macro driven. He's looking for the great ideas that he can hold on to and to compound over long periods of time. I was surprised that some of his interest in some cyclicals in the small cap land, that surprised me a little bit. His value orientation also surprised me. He certainly was more valuation sensitive than I had remembered. But what was really pleasant about him is that despite his intensity, his competitiveness, he spends a lot of time with his family and spends a lot of time going on trips and enjoying life, and was just the warmest human being and just such a pleasant person to be around for half a day out in Los Angeles.
Love that. Love Bogomil sneaking in the questions to get the Peter Lynch stories. You don't get those normally. All right, I got 2 questions, then we're going to get you out of here, Joseph. I promise. 2 more questions. First one, what is one thing you believe about investing that most of your peers would disagree with?
If a stock has doubled or even tripled, you haven't missed it. So many times people think that because they've seen a stock go up significantly, the story's over, they should look elsewhere. And so many times that's just the first act to a very, very long play. And I think about this all the time. sometimes in my mind, and this may be even more controversial to say, I want to see the management team perform. I want to see the stock go up before I buy it. I want to see the story play out. And then I have more confidence that this story has long legs, that I can feel confident that they are on the right path. And there's something to be said for seeing some performance before you invest, particularly in the new issue market. And one of the things I probably should have mentioned about the Peter Lynch conversation that I had is he looks at new issues a lot. We look at new issues as well. We think that there's new opportunities there that the market kind of hasn't discovered yet. And so if a stock has doubled or even tripled, you haven't missed it. I go back to my investment in Constellation Software in 2016. The stock had gone from, I think it IPO'd at around $16 a share to $650 when the geniuses from Los Angeles showed up to the annual meeting 10 years too late in Toronto to meet Mark Leonard and see the story for the first time. The stock had gone from 16 to 600, 650. And the stock chart, when you kind of plotted it on Bloomberg, was as scary a stock chart as you possibly could see. It was a vertical line going straight up like this because the ascension was so significant over those years. And for whatever reason, maybe it was because I had remembered this lesson, for whatever reason, we weren't dissuaded. I think the reason we weren't dissuaded by the move was because cash flow had followed the stock movement. And when you see cash flow following the stock movement, you're not as concerned about this stock going backwards on you because you always have that backstop of forward momentum of the free cash flow going in your favor. And I think that that's maybe one of the more controversial things I could say. If a stock has doubled or even tripled, you have not missed it. Maybe the other controversial thing is you don't have to have an opinion on every security and just focus on your high conviction businesses that you think you can predict and put together a portfolio that comprises those elements.
Would this be the one lesson that you would teach the average investor, or you have one more up your sleeve?
I think the best lesson I could share with the average investor is to buy good businesses as opposed to buy cheap businesses. Mm-hmm. Buy cheap businesses has been popularized for a long period of time. Buy good businesses was undervalued. Now I think it's become fairly valued or maybe overvalued. But if in the event that buy cheap businesses becomes more important than buy good businesses, I would always err on the side of buy good businesses as opposed to cheap businesses, even though that's been popularized. I mean, I was at a dinner recently in Omaha with some investors, and they were talking to me about some cheap chemical companies, and I was a chemicals analyst for 5 years. I was the chemicals analyst at TCW, so I'd spent some time in that industry, and it reminded me, I was fortunate to be aware of how bad, I should say, that industry can be. And so I wasn't moved by the argument at the dinner that, geez, XYZ company is really inexpensive and has prospects for a turnaround. I wasn't moved by that because that company really is in a very, very difficult position with an over-levered balance sheet and in deep trouble because of the acquisition and the leverage that company has taken on. And it looks cheap. It looks very cheap, but it's cheap for a reason. It's got a very difficult position that it's in, and it's got a balance sheet that is inappropriately sized for where they are. So I'd err on the side of quality.
Just going to say that I recently wrote a piece that rhymes exactly what you said with what you said. I called it cheap, expensive truth about cheap investments. I summed up observations from many conversations I've been having with people where when we think it's just so cheap, a stock is just so cheap, better look one more time why it's so cheap, because that's too There's
And,
more than, yeah.
I'm also, to your point, such a good point. I'm reminded, because you brought up Peter Lynch, I'm reminded of two lessons which are basically the same lesson. Peter, in his books, talked about waiting for good results and for the turn before buying in a business. And I'm also reminded of what Will Danoff talks about, which is investing is much like a poker game. And he's looking to gain more information as more cards are revealed on the table before he makes a decision. And I think that exercising that level of care, not needing to catch the first move in every stock, and just taking the time to evaluate how things are playing out, ensuring that things are going well before making an investment, I think is a great lesson as well.
Joseph Shaposhnik, thank you so much for your time today. You're watching Excess Returns. Like, comment, subscribe, all the things below.